Price keeps returning, but each return changes the trade. The week forms inside stacked memory. From May 18th to May 22nd, Bitcoin CME futures did not move through empty space. Every session had a memory above it. Every drop had a memory below it. Every trade had to survive the same question: can price stay there? If price could stay, the trade opened. If price could not stay, the trade failed. That is how the week moved. Not by prediction, by pressure, by failure, by return. We begin with the 1-hour chart. The 1-hour chart gives the live fight. It shows the entry line. It shows the stop line. It shows the target line. It shows when the trade deserves action. It also shows when the trade must be skipped. That part matters, because the chart does not pay you for knowing direction. It pays only when your entry, stop, and target fit the same structure. This week, some trades looked good, but the ratio was weak. Some shorts looked correct, but the timing was dangerous. Some longs appeared late, but the real entry had formed lower. That is the week. Action. Restraint. Then action again. We move through the daily sessions first. May 18th, May 19th, May 20th, May 21st, May 22nd. Each session will show the same process. Where did the session form? Which old boundary did price reach? Where did price fail? Where did it return? Where did risk deserve reward? After that, we move to the larger charts. Daily, weekly, monthly. That is where the 1-hour movement becomes clearer. The 1-hour chart shows the pain. The higher time frame chart shows why the pain repeated. The daily chart shows the battle around the May and February daily memory. The weekly chart shows price losing clean freedom after failing near larger compressed structure. The monthly chart shows May still fighting around the 2026 first monthly lower boundary near the 0.5 area. So do not watch this as a recap. Watch it as execution practice. Every line must answer one thing. Can I enter here? Where am I wrong? Where does price complete the move? If those 3 lines do not exist, there is no trade. If those 3 lines exist, but the reward is weak, there may still be no trade. If price reaches a line and cannot stay, the opposite trade may appear. That is what this week teaches. The market keeps offering movement, but movement alone is not execution. A candle moves. A trader feels pressure. The hand wants to enter, but the structure must allow it. If it does not allow it, you wait. If it allows it, you act. This week will feel repetitive. That is good. Real trading is repetitive. Price reaches. It reacts. It holds or fails. Then the trader decides. Price drops first, but it cannot finish the breakdown. The session forms inside old memory. May 17th Asia session forms slightly wider than April 27th US session box. It overlaps that old US memory. It does not form in open space. It forms inside a place where the market has already fought before. That matters. When a new Asia session forms around an older US box, price does not get clean freedom immediately. It has to deal with old boundaries. It has to test them. It has to hold one side, or fail one side. Until then, the trade is not clear. So the first job is not direction. The first job is location. May 17th Asia starts inside prior US memory. Then, price moves down. It breaks below April 29th US session upper boundary. That is the first loss of support. Then it breaks below April 30th US session upper boundary. That adds pressure. The move looks heavy. The short looks obvious. But obvious moves are often late. Price keeps moving down. It tries to test April 30th U.S. session lower boundary. But the downside does not keep clean distance. The move reaches lower memory. Then the reaction starts. Distance becomes shorter. Continuation starts to slow. The market does not fully accept lower prices. Then price turns up. It breaks back above April 29th U.S. session lower boundary. That is the key change. A line that price lost earlier starts to act like a recovery point. If price reclaims that lower boundary and holds above it, the short loses control. If price returns below it fast, the long is weak. But if price holds there, the long can form. Now price rises toward May 17th Asia session lower boundary. The market is not exploding. It is rebuilding. That difference matters. The long does not come from excitement. It comes from failed downside continuation. Now mark the setup. Long entry line. April 29th U.S. session lower boundary. Stop loss line. April 21st U.S. session upper boundary. Take profit line. April 29th U.S. session upper boundary. Risk-reward ratio 1.85. This is not a large reward setup. That matters immediately. A 1.85 trade can work, but it cannot survive sloppy execution. Late entry weakens the ratio. A wider stop breaks the ratio. A greedy target changes the whole trade. So the entry has to be clean. Why use April 29th U.S. session lower boundary as the long entry? Because that is where price reclaims old memory. After failing to continue down, the market first breaks lower. Then it reaches toward deeper memory. Then it cannot keep pressing. Then it returns above April 29th U.S. lower boundary. That line becomes the decision. If buyers hold it, the long has structure. If buyers lose it again, the long loses its base. You are not buying because price is green. You are buying because sellers fail to keep price below old memory. That is the difference. A green candle can be late. A reclaimed boundary gives a line. Now the stop. Why use April 21st U.S. session upper boundary? Because if price loses April 29th U.S. lower boundary and continues down through older April 21st memory, the long no longer has support. The market would not be rotating back inside the April 29th box. It would be breaking back into lower structure. That damages the long idea. So the stop belongs at April 21st U.S. session upper boundary, not because it feels perfect, not because it gives the prettiest ratio, because that is where the long loses its structural base. Could an aggressive trader place the stop tighter? Yes. A tighter stop can improve the number. It can make the trade look cleaner on paper. It can allow a larger position size. Sometimes price never touches the tight stop. Sometimes that works, but the cost is real. A tight stop can lose the position before the market finishes the rotation. The idea can be right. The position can still be gone. That is why a conservative trader thinks differently. Use a stop that gives the structure enough room. Then reduce size. Do not force a big position when the stop needs to sit deeper. Survival first. Reward second. That is how the account stays alive. Now the target. Why use April 29th U.S. session upper boundary? Because the long entry begins at the lower boundary of that same April 29th box. The first realistic destination is the upper boundary of the box. That completes the rotation. Lower boundary to upper boundary. Old support to old resistance. That is clean. That is measurable. That is enough. Do not turn a 1.85 setup into a fantasy trade. If price reaches April 29th U.S. upper boundary, the trade has done its job. If price stalls there, protect. If price holds above it and builds distance, a new structure can appear later. But the first plan stays simple. Entry at the lower boundary. Stop below the older support logic. Target at the upper boundary. Now think about management. Because the ratio is 1.85, this trade does not give much room for mistakes. If entry is late, the ratio drops. If stop is widened, the trade becomes weaker. If the target is moved higher too early, the trader starts chasing. So management must stay strict. Price must move from April 29th lower boundary toward April 29th upper boundary. If it cannot move away from the entry, the long is not working. If it reaches the midpoint and stalls, the trader must watch reaction speed. If reactions come faster, protect sooner. If pullbacks deepen, the long is weakening. If price keeps holding above the entry and distance keeps growing, the target remains active. This is where traders usually make the mistake. They see the reversal. They believe the bottom is finished. They widen the plan. But the structure only gives April 29th upper boundary as the first clean target. So take what the structure gives. Do not demand more. Now read the full May 17th Asia sequence. May 17th Asia session forms slightly wider than April 27th U.S. session box. It overlaps old memory. Price breaks below April 29th U.S. upper boundary. It breaks below April 30th U.S. upper boundary. It tries to test April 30th U.S. lower boundary. But downside continuation weakens. Price returns. It breaks back above April 29th U.S. lower boundary. Then it tests May 17th Asia lower boundary. That is the recovery. The long entry sits at April 29th U.S. lower boundary. The stop sits at April 21st U.S. upper boundary. The target sits at April 29th U.S. upper boundary. Risk-reward ratio, 1.85. The lesson is simple. Do not chase the drop. Wait for sellers to fail. Do not buy the first green candle. Buy the reclaimed boundary, only if it holds. The breakdown starts the pressure. The failed continuation creates the long. Price reaches. It reacts. It holds or fails. Then you execute. Price drops into older support. Then it rotates back to the middle. The session forms around multiple old boxes. May 18th U.S. session forms while holding April 29th U.S. session box and April 30th U.S. session box together. It absorbs both memories. It does not give a simple clean box. It forms across older structure. That matters. When a U.S. session forms around several prior U.S. boxes, price can move far without becoming clean. The market can test one old boundary, then another, then return to the midpoint. It can look active, but the trade still needs a precise line. Here, the line comes from April 21st U.S. session box. Price first drops. It tests April 21st U.S. session upper boundary. That is the important support test. If price breaks below that line and cannot recover, the long is gone. If price tests it and reacts, the long can form. Price reaches the April 21st upper boundary. It reacts. It moves up. It tests May 18th U.S. session midpoint. Then price turns down again and tests May 18th U.S. session lower boundary. That sequence matters. Lower support. Midpoint reaction. Lower box test. The market is rotating. It is not giving a clean trend. So the trade must be built from the support line and paid at the midpoint, not from hope, not from prediction. Now mark the setup. Long entry line. April 21st U.S. session upper boundary. Stop loss line. April 21st U.S. session lower boundary. Take profit line. May 18th U.S. session midpoint. Risk-reward ratio. 2.92. This is much cleaner than the first setup, from a ratio perspective. But it still needs discipline. Why use April 21st U.S. session upper boundary as the long entry? Because price drops into that old U.S. memory and tests it directly. That boundary becomes the decision line. If it holds, buyers have a place to defend. If it fails, the market can move deeper inside the April 21st box. So the long belongs at the upper boundary, not after the bounce is already far away. You do not buy the midpoint. You buy the support test. The midpoint is the target. That distinction matters. Many traders enter when price already moves. They buy after the bounce is visible. Then the target is closer. The stop is farther. The ratio gets worse. The trade may still move up, but the execution is poor. Here, the entry must come from April 21st U.S. upper boundary. The support test creates the trade. Now the stop. Why use April 21st U.S. session lower boundary? Because if price loses the upper boundary, but stays inside the April 21st box, the market may still rotate. But for this specific long, the logic is the upper boundary hold. If price falls through the entire April 21st box and reaches the lower boundary, the support hold has failed. The trade is no longer clean. So the stop belongs at April 21st U.S. lower boundary. That stop is structural. It is not random. It is not just under the last wick. It protects the idea. If the April 21st box fails, the long leaves. No debate. Now the target. Why use May 18th U.S. session midpoint? Because May 18th U.S. session is wide enough to contain April 29th and April 30th memories. In a wide overlapping session, the midpoint is important. The midpoint is where rotation often slows. The midpoint is where buyers must prove they can control more than just a bounce. So the first target is the midpoint, not the upper boundary, not a huge trend target, just the middle of the current U.S. structure. That keeps the trade realistic. The ratio is 2.92. That is strong enough, if the entry is clean. But the ratio only stays strong when the entry is near the line. If the trader chases after price already moves toward the midpoint, the 2.92 disappears. The same chart becomes a weaker trade. So the rule stays strict. Enter at the line, stop at the structural failure, target at the next memory. Now think about the second movement. After price tests the midpoint, it drops again toward May 18th U.S. session lower boundary. That tells us the market is still rotating. It has not fully accepted above the midpoint. So if the long already reached the midpoint, that profit must be respected. Do not assume continuation. Do not hold the full position just because the bounce looked strong. The midpoint is the target because the market can react there. And it did. That is the proof. Now compare May 17th and May 18th. May 17th gives a 1.85 long. It comes after sellers fail, below April 29th memory. That trade needs clean entry and realistic target. May 18th gives a 2.92 long. It comes from direct support at April 21st U.S. upper boundary. That trade has better space, but it still takes profit at the midpoint because the session is wide and overlapping. Both trades are longs, but they are not the same. One is a recovery back into April 29th memory. The other is a support rotation from April 21st memory to May 18th midpoint. Different location, different stop, different target, different quality. That is how the method works. Not long because price goes up. Not short because price goes down. Every trade must answer three questions. Where does the idea begin? Where does the idea break? Where should the idea pay? For May 18th, the answers are clear. The idea begins at April 21st U.S. upper boundary. The idea breaks at April 21st U.S. lower boundary. The idea pays at May 18th U.S. midpoint. Risk-reward ratio 2.92. Now trader type matters again. An aggressive trader may try a tighter stop. That can increase the ratio. It can increase position size. Sometimes it works. But if the session is wide and contains several old boxes, tight stops become fragile. Normal rotation can touch them. Then the trade still moves to target without the trader. That is the cost. A conservative trader gives more room and reduces size. That feels slower, but it keeps the position alive through normal rotation, especially when the session holds multiple old boxes. Wide overlap needs breathing room. Now trailing. There is no need to force a trail here. The midpoint already explains the trade. If price reaches the midpoint and stalls, protect the trade. If price breaks above the midpoint and holds with distance, a later trail can be considered, but not before the market earns it. A trail should not be automatic. A trail should not come from greed. It only comes after price creates enough distance and after the stop can move without choking the trade. Use at least about 0.5 in risk-reward spacing when building a trail. If the spacing is smaller than that, the trade is reacting to noise. If the stop cannot move beyond entry without becoming too tight, it is often better to take the result. No forced trail. No forced continuation. Now read the full sequence. May 18th U.S. session forms while absorbing April 29th U.S. box and April 30th U.S. box. Price drops to April 21st U.S. upper boundary. That gives the long line. Price rises to May 18th U.S. midpoint. That gives the target. Then price drops to May 18th U.S. lower boundary. That confirms the rotation. The long was valid. The target was realistic. The midpoint was not just a random number. It was the place where price actually reacted. So the trade plan was correct. Entry: April 21st U.S. upper boundary. Stop: April 21st U.S. lower boundary. Target: May 18th U.S. midpoint. Risk-reward ratio 2.92. The lesson is direct. A wide session does not mean a wide target. An overlapping session does not mean chase. When several memories sit inside one box, the midpoint becomes important. Support gives the entry. The midpoint gives the pay zone. If price reaches, if it reacts, if it holds or fails, then the trade appears. Price drops first. But the long is not born from strength. The session forms below the midpoint. May 18th Asia session forms below the midpoint of May 18th U.S. session box. It compresses by about 25%. It overlaps the same active memory. It does not form in open space. It forms under the middle of the prior US structure. That matters. When a session forms below the midpoint, buyers do not control the chart yet. They have to prove it. They have to defend the lower side. They have to stop the drop. They have to make sellers fail. If they cannot do that, the long is only hope. So the first task is not to buy early. The first task is to watch the lower test. May 18th Asia session starts inside compression. Then price falls. It moves down toward May 18th US session lower boundary. That is the first pressure point. If price breaks through and keeps distance, the long should not be touched. If price reaches the lower side and reacts, the trade can begin to form. Price reaches lower memory. It tests. It does not keep clean downside distance. The drop starts to lose force. Reaction comes back. Then price starts to lift. It moves back toward May 18th Asia session upper boundary. Now the chart changes. The first drop no longer controls everything. Sellers had the chance to push lower. They had the line. They had the move. But they could not keep it clean. That is where the long becomes possible. Not before. Now mark the setup. Long entry line. May 18th Asia session negative 200% area. Stop loss line. May 18th Asia session negative 300% area. Take profit line. May 18th Asia session 100% area. Risk-reward ratio 2.02. This is a clean mathematical setup, but it is not an easy environment. That matters. May 18th Asia session formed below the midpoint of May 18th US session box. It formed compressed. It formed inside prior memory. It formed under pressure. So a trader can take the setup, but a trader can also skip it. Both can be correct. The difference comes from execution quality. If price reaches the negative 200% area and reacts cleanly, the long has a line. If price hesitates there and keeps dropping, the long disappears. If price returns above the line and starts to build distance, the long has structure. So the entry is not random. It sits at the negative 200% area because that is where the failed downside extension appears. The market already stretched lower. It tested the seller side. If sellers cannot keep price below that extension, buyers get a chance to reclaim the box. The long starts from that failed extension, not from a green candle, not from a feeling, not from wanting the bounce. Now the stop. The stop sits at May 18th Asia session negative 300% area. Why there? Because the long is built from failed downside pressure. If price loses the negative 200% area and then continues to negative 300%, the seller side has not failed. The seller side is still pressing. The long idea loses control. So the stop must sit where the failed extension story breaks. If price reaches negative 300%, you leave. No argument. No waiting. No extra candle. The trade has lost its base. Now the target. The target sits at May 18th Asia session 100% area. Why there? Because the long begins from a deep downside extension. The first real goal is not a fantasy breakout. The first real goal is return through the Asia structure, from negative 200% back toward the 100% area. That is a full recovery through the box. That is enough. That gives the trade a 2.02 ratio. That ratio can work, but only if entry stays clean. If the trader enters late, the 2.02 disappears. If the stop gets widened, the structure weakens. If the trader moves the target higher too soon, the trade becomes emotional. So this setup needs precision. May 18th Asia is not a perfect clean trend session. It is a compressed session under US midpoint memory. That is why no trade is also valid. A trader who needs cleaner structure can wait. A trader who can execute fast can use the negative 200% line. But the plan must stay strict. Enter at the line. Stop at the next failed extension. Target at the 100% area. Now think about risk style. An aggressive trader may tighten the stop. That improves the ratio on paper. It may allow larger size. Sometimes the tight stop survives. Sometimes price turns exactly there. But the cost is real. A tight stop can get touched by normal reaction. Then the position is gone, before the move returns to the target. The idea can be right. The trade can still be lost. That is why a conservative trader behaves differently. A conservative trader gives the stop more room. Then position size gets smaller. The risk remains controlled. The trade survives more noise. That matters here because the session formed inside compression. Compressed sessions often create small shakes before the real move appears. If the stop is too tight, the chart can remove the position and then still go to target. That is not a strategy problem. That is an execution problem. Now trailing. There is no need to force a trail before the target. The first target already defines the trade. If price reaches the 100% area and stalls, protect. If price reaches the target and holds with distance, a later trail can be studied, but the market must earn that. The trail should not be automatic. A trail only works when price creates distance and the stop can move without choking the trade. Use at least about 0.5 in risk-reward spacing when building a trailing plan. If the spacing is too small, normal pullback can hit the stop. If the stop cannot move beyond entry, without becoming too tight, it may be better to take the result. No forced trail. No forced continuation. Now read the full sequence. May 18th Asia session forms below May 18th US session midpoint. It compresses by about 25%. Price falls. It tests. May 18th US session lower boundary. The downside move cannot keep clean distance. Price reacts. It rises back toward May 18th Asia upper boundary. That gives the long condition. Entry. May 18th Asia negative 200%. Stop. May 18th Asia negative 300%. Target. May 18th Asia 100%. Risk-reward ratio 2.02. The lesson is direct. A compressed session under the midpoint does not give an automatic long. It gives a test. Sellers must fail first. The long starts only after that failure. Price reaches lower memory. It reacts. It holds or fails. Then the trade appears. Price compresses at the lower boundary. Then it tests old support again. The session forms inside lower memory. May 19th US session forms at the lower boundary of May 18th US session box. It compresses by about 50%. It overlaps the same lower structure. It does not open with clean trend freedom. It opens inside the place where the market already tested pressure. That matters. When a US session forms at the prior lower boundary, the market is not giving easy direction. It is asking one question. Can the old support hold again? If it holds, the long can form. If it fails, the move can break lower. The answer must come from behavior, not from opinion. May 19th US session first moves lower. It drops into April 21st US session upper boundary. That is the important line. It is old memory. It is not a random support. It is the place where buyers must appear if the market wants to rotate higher. Price reaches that line. It tests it. Then price rises. It pushes toward May 19th U.S. session upper boundary. Now the long structure appears. But the trade is not generous. That matters. Long entry line. May 18th Asia session negative 300% area. Stop loss line. April 21st U.S. session lower boundary. Take profit line. May 19th U.S. session upper boundary. Risk-reward ratio. 1.52. This ratio is tight. A 1.52 setup can work, but it cannot accept sloppy execution. It cannot accept late entry. It cannot accept a wider stop. It cannot accept a fantasy target. The trade must be clean, or it should be skipped. Now look carefully at the entry. Why use May 18th Asia session negative 300% area? Because the market is still working around the failed downside extension from the prior Asia structure. That level becomes the deep decision line. If price comes into that area and cannot continue lower, the long can rebuild. But the entry must be near the line. If price already moves toward the U.S. upper boundary, the trade is too late. The target gets closer. The stop remains far. The ratio collapses. So the entry is not the bounce. The entry is the deep support decision. Now the stop. The stop sits at April 21st U.S. session lower boundary. Why there? Because April 21st U.S. box becomes the real support structure under the trade. If price loses the deep Asia extension and then breaks through April 21st U.S. lower boundary, the long no longer has a base. The old support failed. The rotation failed. The trade has lost its reason. So the stop sits where the support story breaks. Not one candle under entry. Not at a random wick. At the lower boundary of the old U.S. box. If price reaches there, the long should be gone. Now the target. The target sits at May 19th U.S. session upper boundary. Why there? Because May 19th U.S. formed compressed at the lower boundary of May 18th U.S. session box. Once price holds lower support, the first realistic destination is the upper side of the current U.S. session box. That is the cleanest pay zone. Not a higher breakout. Not the next week's fantasy. Just the box top. That target gives 1.52. Again, tight, but measurable. Now the problem. When a trade gives only 1.52, the trader must be honest. A clean entry may justify it. A late entry destroys it. If you miss the lower line, do not chase the upper move. If price reaches the target, take the result. If price stalls before the target, reduce risk. If price loses support, exit. No debate. A tight ratio trade is not a place to prove conviction. It is a place to execute mechanically. Now compare this to the May 18th Asia setup. May 18th Asia gave a 2.02 long from negative 200% to 100%. That was already a setup where no trade could be valid because the session formed below the U.S. midpoint. May 19th U.S. gives an even tighter 1.52. So the trader must be more selective. If the line is clean, the trade can work. If the line is missed, the trade should be skipped. There is no need to force it. Now think about the aggressive trader. An aggressive trader may tighten the stop. That can improve the ratio. It can make the trade look more attractive. But May 19th U.S. forms at the lower boundary of prior U.S. memory. That area can rotate It can wick. It can shake. It can test deeper before moving up. So a tight stop may get touched easily. The aggressive trader must accept that. More size. Less room. More frequent failure. That is the exchange. A conservative trader gives the trade more room and reduces size. But with a 1.52 setup, even the conservative trader must ask whether the trade is worth it. Sometimes the best answer is wait. Not because the idea is wrong, because the reward is not generous enough. That is real trading. The chart can offer a valid setup and still not offer a comfortable trade. Now trailing. Do not force trailing here. The target is the May 19th U.S. upper boundary. That is the plan. If price reaches it, the trade has paid. If price breaks above it and holds with distance, a later structure can be considered, but the original trade should not assume it. A 1.52 trade must respect the first target. If you try to stretch it too early, you may give back the only reward it had. Trailing belongs to trades that earn distance. This one first needs to pay. Now read the full sequence. May 19th U.S. session forms at May 18th U.S. lower boundary. It compresses by about 50%. Price drops. It tests April 21st U.S. upper boundary. Then price rises. It tests May 19th U.S. upper boundary. The long entry sits at May 18th Asia, negative 300%. The stop sits at April 21st U.S. lower boundary. The target sits at May 19th U.S. upper boundary. Risk-reward ratio, 1.52. The lesson is clear. The market can hold old support. The market can rotate up. But the trade is only clean when the entry is taken at the deep line. Late entries are weak. Wide stops break the ratio. Unrealistic targets damage the method. So the plan stays strict. Deep support line. Structural stop. Current session upper boundary target. Price reaches. It reacts. It holds or fails. Then the trade appears. Price dips first. But the lower side does not open. The long begins at the edge. May 19th Asia session basis box forms almost directly on top of the May 19th U.S. session box. That matters immediately. The market is not starting from fresh space. It is starting from overlap. It is starting from repeated memory. When one session forms almost identical to another session box, the market is telling you that price is not free yet. It is trapped inside a known area. That can reduce clean breakout quality. But it also makes the edges more useful. The lower edge matters more. The upper edge matters more. The midpoint matters more. You are not looking for a random candle. You are looking for where memory fails or holds. May 19th Asia session first drops. It tests the lower boundary of the May 19th U.S. session box. That is the first important moment. If the lower boundary breaks and stays broken, then the whole long idea weakens. If it only tests and returns, then that lower side becomes usable support. The difference is not the touch. The difference is whether price can stay there. That is always the pressure point. Price pushes lower. It reaches the lower boundary, but it does not keep building distance below it. The downside pressure cannot expand. Bodies do not continue cleanly. The move stalls. That is the first clue. Then price turns up. Now the behavior changes. Price rises through the session. It breaks above the upper boundary of the May 19th Asia session basis box. That matters because the market is no longer just bouncing inside noise. It is now reclaiming its own session structure. Then price keeps pressing and reaches the upper boundary of the May 18th U.S. session box. That becomes the next memory test. So the move is clear. Test the lower side. Hold. Reclaim the local box. Push into prior US memory. Now the trade logic. Long entry line. May 19th Asia session basis box lower boundary. That is the line. Not because it feels cheap. Not because the candle is green after it. Because that is where the session proves whether the lower side can hold. When a session forms almost fully overlapped with prior US memory and price drops into the lower edge without opening fresh downside space, the lower boundary becomes the decision line. If that line holds, you have a structure-based long. If that line fails, the trade idea is wrong. That is why the entry belongs there. You are not chasing the breakout at the top. You are not buying the first green excitement. You are entering where the structure lets you define risk. That is the whole method. Entry is not about feeling early. Entry is about knowing exactly where the trade should not fail. Now the stop. Stop loss line. April 21st US session box upper boundary. That is a deeper stop than an aggressive trader may want. But it is the more stable line. Why does it belong there? Because below the May 19th Asia lower boundary, the market still has room to shake. This session is forming on top of repeated memory. The lower side can be tested more than once. If you place the stop too close, the market can tap it and still perform the original long. Then the stop was not protecting the idea. It was only protecting emotion. The April 21st US upper boundary is the more meaningful invalidation line because if price falls that far, it is no longer just retesting the local overlap. It is losing older support memory underneath. At that point, the entire reclaim logic is damaged. So that is where the trade is wrong. Not uncomfortable. Wrong. That distinction matters. Aggressive traders may tighten the stop. They may reduce the stop distance and raise size. That can work when reactions are sharp and immediate. Sometimes price never comes back for that deeper test. But the risk is simple. A tighter stop can lose the position before the structure finishes working. A conservative trader does the opposite. The stop goes deeper. Position size gets smaller. The idea is to survive the natural shake inside overlapping memory. That does not make the trader weak. That makes the trader consistent. You are not trying to win one candle. You are trying to stay inside the valid structure long enough to get paid. Now the first target. Take profit line. May 19th Asia session basis box upper boundary. Why there? Because the first job of the long is not to conquer the world. The first job is to complete the rotation from the lower edge to the upper edge of its own session structure. That is the cleanest first objective. When a long begins at the lower boundary of an overlapped box, the first target should usually be the opposite side of that same box unless price shows earlier signs of failure. This gives the trade symmetry. This gives the trade a natural range objective. And this is important. A target should not be chosen only because the number looks large enough. It should belong to the structure. That upper boundary belongs to the structure. Once price reaches that first target, the trade has already worked. Now the trailing decision becomes possible. Trailing target. May 18th US session box upper boundary. Risk-reward ratio. 2.72. That second objective is not random either. Once price reclaims the top of the May 19th Asia box, it is entering the next layer of memory above. The May 18th US upper boundary is the next place where older sellers may react. So if price reaches the first target and still holds distance, the trade can stay alive into that next memory, but only if price earns it. That is the key phrase. Price must earn the trail. You do not trail because you want more. You trail because price has already shown the ability to hold above the first objective. If price reaches the upper boundary and immediately collapses back inside the box, then the trail has not been earned. If price holds above, or reacts shallowly and continues, then the extension is valid. Now the trailing rule. When the target moves, the stop must move too. A new target with an old stop is not trade management. It is wishful thinking. But the stop cannot become too tight. If you drag the stop too close behind the last candle, small noise can hit it. Then the trail cuts profit instead of protecting it. That is why trailing distance matters. A useful rule is simple. The interval between trailing decisions should usually be at least half of the original risk-reward unit. That keeps the trail meaningful, not nervous. Also remember one more condition. If the adjusted stop still cannot move beyond the entry without becoming structurally weak, then sometimes trailing is not worth it. In that case, taking profit without trailing can be the better decision, because the market has not created enough excess distance to justify a second stage. Now think about partial profit. A conservative trader may take 60% at the first target and leave 40% for the trail. That works when the first range objective is already a good payout, and the trader wants to protect the session's main win. An aggressive trader may do the opposite. 40% first, 60% left open. That only makes sense if price keeps distance and the reaction stays shallow. If a move becomes a larger two-stage extension over time, then a conservative approach can use 50%, then 30%, then 20%. A balanced trader can use 25%, then 50%, then 25%. An aggressive trader can use 20%, then 30%, then 50%. But the percentages matter less than the structure. If the market starts shrinking bodies and printing faster rejection near the first target, protect more. If it keeps lifting and holding above reclaimed levels, let more remain. Now step back and read the whole move. May 19th Asia forms almost directly on top of May 19th US memory. Price drops into the lower boundary of that memory. The downside cannot expand. Support holds. Price turns. It breaks the Asia upper boundary. Then it reaches the May 18th US upper boundary. The long begins at the lower edge, because that is where failure can be defined. The stop sits at the April 21st US upper boundary, because that is where the reclaim idea truly breaks. The first target sits at the Asia upper boundary because the first job is to complete the box rotation. The trail reaches the May 18th US upper boundary because that is the next memory above. Risk-reward ratio 2.72. One more point matters. Because the May 19th Asia box is almost identical to the prior US box, no trade is also a valid decision. That overlap can keep price trapped. It can keep reaction small. It can make the session slow. So if the lower side does not show a clean hold, stepping aside is not a missed opportunity. It is discipline. The long only becomes clean after the lower side refuses to open. That is the edge. That is the execution. Price stays inside memory, but the lower side keeps paying. The long begins again from support. May 20th US session basis box forms almost directly on top of the May 18th US session box. That overlap matters at once. Again, the market is not opening into fresh space. It is reusing a known area. That can frustrate traders who want explosive clean trend. But for a structure trader, that kind of repetition is useful. It tells you where the boundaries matter. It tells you where the long must hold. It tells you where the move becomes invalid. Price continues inside the May 20th US session box. It does not immediately break out. It rotates first. That is important. Because when a session forms almost identical to older memory, the market often needs to prove itself through repeated tests before distance appears. You see the slow movement. You see the box holding price. You feel the temptation to chase the first small push. That is where bad entries begin. Not here. The correct approach is still the same. Wait for the edge. Let the structure speak. Then, price pushes higher. It reaches toward the lower boundary of the April 27th US session box. That is older memory above. So the session is doing two things at once. It is holding the new overlapped box from below. and it is climbing into prior resistance from above. Now the trade logic. Long entry line. May 20th U.S. session basis box lower boundary. That is the entry. Why there? Because the session is forming almost on top of the May 18th U.S. box, so the lower edge of the current box becomes the clearest decision line for buyers. If price sits above that line, rotates, and then responds upward, the market is telling you the lower edge is being defended. That is a cleaner long than buying in the middle of the box. A midpoint entry often leaves you with weaker reward and less clarity. A lower boundary entry gives you both. It gives you price advantage, and it gives you a clear place where the trade should fail if it is wrong. That is why the long belongs at the lower boundary, not at the top after the move is already obvious. Not in the middle where risk and reward both become blurry. Now the stop. Stop loss line. May 19th U.S. session box, lower boundary. This stop sits beneath the local support cluster. That matters because the May 20th session is leaning on the strength of the recent overlapping structure. If price falls through the May 20th lower boundary, there is still one more question. Can the previous session memory beneath it hold? The May 19th U.S. lower boundary answers that question. If price loses both the current lower boundary and that prior lower boundary, then the support stack has failed. The long no longer has clean ground underneath it. The overlap that helped the trade now turns against it. So the stop belongs there. Aggressive traders may again choose a tighter stop, perhaps under the current session only. That can improve the ratio. But it also increases the chance of being removed by ordinary rotation. A conservative trader accepts the deeper stop and cuts size. That gives the trade more room to survive the repeated testing that often happens inside these overlapping session boxes. The choice depends on the trader. But the principle does not change. The stop must sit where the structural reason for the trade ends. Now the first target. Take profit line. May 20th U.S. session basis box upper boundary. That is the natural first objective. Why? Because the move begins from the lower edge of the current box. The first clean job is to complete that rotation from low to high. Until that happens, the trade has not yet finished the most basic work. You do not skip the local objective and start dreaming about the bigger breakout immediately. You let the market finish one task first. That is what keeps the method calm. That is what keeps you from over-projecting. Once price reaches that top side, the long has proven the box rotation. Only after that does the next question appear. Can the move extend into older memory above? That is where the trail comes in. Trailing target. The lower boundary of the April 27th U.S. session box. Risk-reward ratio, 2.23. That upper memory is not chosen because it is simply farther away. It is chosen because it is the next structural ceiling that price is already reaching toward. The current session rises until it tests that April 27th lower boundary. That means the trail is not fantasy. It is grounded in the chart. But the same rule applies again. The trail must be earned. If price only pokes the top of the current box and immediately falls back, the long has done its first job but not enough for a higher objective. If price reaches the upper boundary, holds its gain, and continues pressing, then the trail becomes valid. That is how execution stays honest. Now think about the behavior inside the box. The session continues within its own structure for a long stretch. That can make traders impatient. They see small up candles. They see small down candles. They enter too early, or they give up too soon. But overlapping session memory often behaves like that. It rotates until one side proves stronger. The correct response is not impatience. It is selection. Wait for the lower edge to hold. Wait for the return from the lower side. Then let the range complete. That is why this long is cleaner from the lower boundary than from any other place. Now the stop and target movement. Once price reaches the first target, the stop must follow. Again, the stop cannot stay too far away. The trade has already earned distance. profit must be protected. But the stop also cannot be dragged so tightly that one normal pullback erases the second stage. The trailing gap should still respect the rhythm of the session. A useful guide remains the same. Do not trail with tiny nervous adjustments. Let each adjustment represent at least about half a unit of original risk-reward. That makes the trail structural rather than emotional. If the market has not created enough room to move the stop meaningfully, then extending the target may not be worth it. That is an important lesson. Not every valid trade deserves a big extension. Some only deserve the first target. Others deserve one more layer. The chart decides, not desire. Now, think about profit distribution. A conservative trader may take 60% at the top of the current box and leave 40% for the trail into the April 27th lower boundary. An aggressive trader may leave 60% open if price keeps lifting cleanly and the pullbacks remain shallow. If later extensions create more layers, then scaling choices can expand into 3 steps. A conservative trader may take 50, then 30, then 20. A balanced trader may use 25, 50, 25. An aggressive trader may use 20, 30, 50. But only if structure continues to open upward. If price slows near the first target, shrink the ambition. If price keeps accepting higher levels, allow the trail. Now read the session from beginning to end. May 20th US forms almost directly on top of May 18th US memory. Price rotates within the current box. The lower side holds. That makes the lower boundary the usable long entry. The stop sits under the May 19th US lower boundary because losing both support layers would break the long idea. The first target is the May 20th US upper boundary because the first job is to complete the session rotation. Then, if price holds and presses higher, the trail reaches the lower boundary of the April 27th US session box. Risk-reward ratio 2.23. The session teaches something larger too. Repeated overlap does not always mean weakness. Sometimes it means the market is building a platform. But you only know that after the lower edge survives testing. That is why patience matters. That is why entry location matters. That is why buying the middle of the box is usually weaker than buying the defended edge. And that is why structure can turn a slow session into a clear trade. The market does not need to look dramatic. It only needs to behave correctly. Lower boundary holds. Rotation completes. Old memory gets tested. That is enough. That is the trade. That is the execution. Price moves up, but it cannot stay free. The session forms inside compressed memory. May 20th Asia session forms at the midpoint of May 20th US session box. It compresses by about 50%. It overlaps there. It does not start from open space. It starts inside a decision area. That matters. When a session forms at the midpoint of the same day US memory, the market is already balanced. Price is not free. It is squeezed. One side must prove control. If buyers hold above the midpoint, the move can push higher. If buyers fail above old memory, price can return fast. May 20th Asia session first moves up. It breaks above May 20th US session upper boundary. That looks strong. It looks like continuation. It looks like buyers have control. But strength still needs holding. Price reaches higher. It tests April 27th US session midpoint. That level is not random. It is older memory. It is where price must prove that the breakout can continue. Price reaches the level. It reacts. It cannot build clean distance. The push slows. Bodies become smaller. Pullbacks deepen. Reaction comes back faster. That is the first warning. If price were truly strong, it would move away from that midpoint. It would hold above broken memory. It would not hesitate so soon. But here, distance does not grow. The move stalls. Continuation fails earlier. Then price turns down. It falls back through the upper area. It returns toward May 19th U.S. session lower boundary. The whole move changes. The breakout was not free. The test at April 27th U.S. midpoint became pressure. Now the short idea appears. Short entry line. April 27th U.S. session lower boundary. Stop loss line. April 27th U.S. session upper boundary. At the 150% area. Take profit line. May 20th Asia session lower boundary. Risk-reward ratio. 1.08. That number matters. The idea can make sense. But the ratio is weak. A trade can be structurally valid and still not worth taking. That is where discipline begins. The short entry uses April 27th U.S. session lower boundary. Why there? Because price already pushed into April 27th U.S. memory and failed to build distance. If price returns below the lower side of that April 27th U.S. structure, the breakout attempt loses control. The lower boundary becomes the decision line. If price falls below it and cannot reclaim it, the short can begin. But the stop creates the problem. The safer stop sits at April 27th U.S. session upper boundary at the 150% area. That gives the trade room. It keeps the stop away from noise. It respects the fact that price already tested higher memory with strong movement. But that room costs something. It widens the risk. It lowers the ratio. The reward to May 20th Asia session lower boundary does not pay enough. Risk-reward ratio stays near 1.08. That is not attractive. So the trader faces a real decision. Take a weak ratio, or skip the trade, or tighten the stop. An aggressive trader may choose April 27th U.S. session upper boundary as the stop line. That tightens the risk. The ratio improves. The position size can become larger because the stop distance becomes smaller. Sometimes that works. Price never touches the tight stop. The short pays. The account grows faster. But that is not free. A tight stop has a cost. It can get touched by normal reaction. It can remove the position before the real move begins. You can be right about direction and still lose the trade. That is the pressure. A conservative trader sees it differently. The conservative trader does not force the thinner stop. The conservative trader gives the structure room. The position size becomes smaller because the stop is deeper. The trade survives more noise. The chance of being stopped before the target decreases. But the ratio becomes weak. So the conservative answer can also be no trade. That is important. Conservative does not always mean a wider stop and smaller size. Sometimes conservative means do not enter, because the trade does not pay enough. Now look at the actual target. Take profit sits at May 20th Asia session lower boundary. That is where the session box completes its return. If price fails from April 27th U.S. memory and comes back into May 20th Asia structure, the lower boundary becomes the first clean objective. Not because we predict a collapse, because that is where the failed push can complete the rotation. Price moves down. The short pays enough to watch, but the first plan is still limited. So trailing becomes the only way to improve the trade. Trailing target. May 20th U.S. session lower boundary. Risk-reward ratio 1.41. Still not amazing, but better. The trail makes sense only after price earns distance. The move must break lower. It must stay below the entry memory. It must not reclaim April 27th U.S. lower boundary fast. If price only touches the first target and snaps back, the trade has done enough. If price holds lower and distance keeps opening, then May 20th U.S. session lower boundary can become the trailing target. Now the stop must follow. A target that moves without a stop is just hope. The market already paid. The trader must protect what was earned, but the stop cannot be too tight. If the stop is pulled too close, normal reaction removes the position. Then the trailed version earns less than the original plan. If the stop stays too far back, the trail protects nothing. So the stop follows structure, not fear, not greed, not the last candle. The interval matters. A trailing move should usually wait for at least about 0.5 risk-reward unit of additional distance. Less than that can become noise. More than that gives the trade a reason to adjust. If you trail too early, you suffocate the position. If you trail too late, you give back too much. Now partial profit can help. If price reaches the first target and reaction starts to speed up, protect more first. A conservative trader can take 60% first and leave 40% for the trail. If price keeps pressing lower and pullbacks stay shallow, an aggressive trader can leave more open. An aggressive trader can take 40% first and leave 60% for continuation. If there are two trailing stages, the same logic applies. A conservative trader can take 50% first, then 30%, then 20%. A balanced trader can take 25% first, then 50%, then 25%. An aggressive trader can take 20% first, then 30%, then 50%. But the percentages do not save a weak trade. They only manage a trade that already has structure. If price cannot keep distance, protect more. If price keeps distance, let the remaining position work. Now return to May 20th Asia. The session forms at May 20th U.S. midpoint. It compresses by 50%. Price breaks above May 20th U.S. upper boundary. It tests April 27th U.S. midpoint. It cannot build distance. Then it returns lower. The short can form at April 27th U.S. lower boundary. The safe stop is deeper. The ratio is weak. The aggressive stop improves ratio, but reduces survival. The target is May 20th Asia lower boundary. The trailing target is May 20th U.S. lower boundary. Risk-reward ratio moves from 1.08 to 1.41. The lesson is not just short. The lesson is trade selection. A valid level does not always give a valid trade. The level can be right. The behavior can be right. The ratio can still be poor. That is where a trader must decide. Accept lower quality. Tighten the stop and accept stop risk. Or skip. The market does not force the trade. The structure gives the choice. Price reaches. It reacts. It fails to hold. But the account only trades when risk deserves the reward. Price returns again. But this time the overlap supports the long. The session forms inside stacked memory. May 21st U.S. session forms overlapping May 19th U.S. session box and May 20th U.S. session box. It does not overlap only one memory. It overlaps multiple sessions. That matters. One overlap can create pressure. Multiple overlaps add weight. When several session boxes sit together, price is not moving through empty space. It is moving through stacked decisions. Old buyers, old sellers, old failures, old returns. Everything is close. So the next break matters more. May 21st U.S. session first stays inside its own session box. It does not rush. It rotates. Bodies stay controlled. The market waits. Then price begins to lift. It breaks above April 27th U.S. session lower boundary. That level mattered earlier. It was part of the short decision. Now price is returning through it. That changes the frame. A level that failed before can become the line price must reclaim now. If price breaks above it and immediately returns, the long is not ready. If price breaks above it and holds, the long can begin building. Price continues higher. It tests April 27th U.S. session midpoint. That is the larger objective. The same old memory appears again. But the trade is different now. This time the entry does not start at April 27th memory. It starts inside May 21st U.S. session. Long entry line. May 21st U.S. session midpoint. Stop loss line. May 19th U.S. session lower boundary. Take profit line. May 20th U.S. session upper boundary. Trailing target. April 27th U.S. session midpoint. Risk-reward ratio 2.47. This setup is cleaner. The long entry sits at May 21st U.S. session midpoint. Why there? Because May 21st U.S. session forms inside multiple overlapping boxes. The midpoint becomes the internal decision line. If price holds below the midpoint, buyers do not control the session. If price reclaims the midpoint and starts building distance, the long can form. You are not buying after price reaches April 27th midpoint. That is too late. You are buying when price proves it can hold the May 21st U.S. midpoint. The midpoint is where the session changes. Below it, rotation continues. Above it, buyers start pressing. Price reaches the midpoint. It reacts. It holds. It moves away. Distance begins to open. That is the long. The stop sits at May 19th U.S. session lower boundary. That stop is not arbitrary. May 21st U.S. session overlaps May 19th and May 20th memory. If price loses May 19th U.S. lower boundary, the stacked overlap has failed. The long is no longer protected. The market has fallen back through the base memory that supported the trade. So the stop belongs there. Not too tight. Not emotional. At the line where the idea breaks, an aggressive trader may want a tighter stop. That can increase position size. That can improve the visible ratio. Sometimes it works. Price never touches the tight stop, but the danger is the same. If the stop is too close, inside stacked memory, normal rotation can remove the trade. The idea survives. The position does not. That is the mistake. A conservative trader gives the structure room. The stop goes deeper. The size becomes smaller. The trade survives more noise. The account risk stays controlled. That is the balance. Tighter stop, bigger size, lower survival, wider stop, smaller size, higher survival. Neither is always right. The trader must know which risk they are taking. Here, May 19th U.S. lower boundary gives the structure room. It keeps the long alive, unless stacked memory truly fails. The first target sits at May 20th U.S. session upper boundary. Why there? Because May 20th U.S. memory is part of the overlap. If May 21st U.S. midpoint holds and price moves higher, May 20th U.S. upper boundary becomes the first clean objective. It is not random. It is the top side of the memory price is trying to reclaim. Price moves higher. It reaches the first target. The trade pays. Now trailing can begin. Trailing target. April 27th U.S. session midpoint. Risk-reward ratio. 2.47. That is a better structure than the earlier short. The earlier short had a problem. The safer stop made the ratio weak. The aggressive stop made survival weaker. Here, the long has more room and a better target. The setup is cleaner. The risk-reward is stronger. The overlap gives a better base. Now the trail must still be earned. Price must hold above May 20th U.S. upper boundary. It must not return back into May 21st U.S. midpoint quickly. It must create distance. If it reaches the first target and stalls immediately, take the profit. If it holds and keeps moving, April 27th U.S. midpoint becomes possible. But once again, the stop must move with the target. A target that moves without a stop is only hope. The trade has already paid. Now protect the distance. The trailing interval should not be random. A useful trail usually waits for at least about 0.5 risk-reward unit of additional movement. That gives enough room for the trade to breathe. If you trail every small candle, the stop becomes too tight. If you never trail, profit is left unprotected. So the stop follows the next structure, not the next emotion. If price holds above May 20th U.S. upper boundary, the stop can follow under the latest accepted memory. If price returns below that area and cannot recover, the trail should protect the position. Partial profit can help here too. If price reaches the first target and the move starts to slow, protect more first. A conservative trader can take 60% first and leave 40% for continuation. If price holds the target and continues to build distance, an aggressive trader can keep more open. An aggressive trader can take 40% first and leave 60% for continuation. For two stages, the logic changes with behavior. If the second push starts to slow, do not wait for the perfect top. A conservative trader can take 50% first, then 30%, then 20%. If pullback stays shallow and reaction does not return fast, a balanced trader can take 25% first, then 50%, then 25%. If price keeps pressing and the structure keeps holding, an aggressive trader can take 20% first, then 30%, then 50%. But again, numbers do not replace structure. They only manage it. Now watch the full May 21st U.S. setup. May 21st U.S. session forms overlapping, May 19th U.S. box, and May 20th U.S. box. Price moves inside the session box. Then it breaks above April 27th U.S. lower boundary. It continues higher. It tests April 27th U.S. midpoint. The long entry sits at May 21st U.S. midpoint. The stop sits at May 19th U.S. lower boundary. The first target sits at May 20th U.S. upper boundary. The trailing target sits at April 27th U.S. midpoint. Risk-reward ratio, 2.47. The difference from the earlier short is clear. The short appeared first, but the ratio was weak. The long appeared later, but the overlap gave better structure. Same memory, higher target, better quality. That is why the trader does not marry direction. You do not say short only. You do not say long only. You read the session. You read the risk. You read the target. If the short has poor reward, you do not force it. If the long gives stacked support and a cleaner target, you take it. That is execution, not prediction. The market gives different quality at different moments. Your job is not to trade every idea. Your job is to trade the idea that survives risk. May 20th Asia showed the danger of poor risk-reward. May 21st US showed the value of overlap and patience. One trade asks whether the short is worth the risk. The next trade answers with a cleaner long. Price reaches. It reacts. It holds or fails. Then the trader decides whether the reward is worth the risk. Price looks trapped, but the real box is bigger. The session forms inside compressed memory. May 22nd Asia session forms between May 21st US session upper boundary and April 27th US session lower boundary. It forms near the middle of that space. It compresses too much. It overlaps. It does not give clean distance inside its own box. That matters. When a session basis box is too compressed, the box itself can become too small for clean execution. The visible box still matters, but price may start trading as if the larger old boundaries are the real working box. That is what happens here. May 22nd Asia session forms tight. Then price moves between May 21st US session upper boundary and April 27th US session lower boundary. It behaves as if that wider zone is the active box. The small box gives the pressure. The older boundaries give the trade. That is the first lesson. Compression can hide the real working range. May 22nd Asia session first moves around inside the compressed area. It does not leave cleanly. Bodies stay controlled. Distance stays short. Reactions come back. The market is not free yet. Then price pushes upward. It reaches May 21st US session upper boundary. It tests. It reacts. It tries to hold. The long idea appears there. Long entry line. May 21st US session upper boundary. Stop loss line. May 21st US session midpoint. Take profit line. April 27th US session lower boundary. Risk-reward ratio 1.64. The long does not appear because price is simply green. It appears because price is trying to hold above May 21st US upper memory. That line becomes the decision line. If price holds above it, the move can reach toward April 27th US lower boundary. If price cannot hold above it, the long loses control fast. That is why the entry is not random. May 21st US upper boundary is the first place where buyers must prove they can move out of the compressed May 22nd Asia structure. The stop sits at May 21st US session midpoint. Why there? Because the long is using May 21st US upper memory as support. If price falls back to the midpoint, the upper boundary hold has failed. The trade no longer has control. The move has returned inside old balance. So the midpoint becomes the damage line. If price reaches it, the long is no longer clean. The target sits at April 27th US session lower boundary. That sounds unusual at first. But price is moving inside the larger range between May 21st US upper boundary and April 27th US lower boundary. The target is not chosen because it is far. It is chosen because price already treated that older April 27th US line as the next boundary. The market is not following the tiny box only. It is following the wider memory, so the long target belongs there. Now look at the problem. The long has a ratio of 1.64. That is usable, but not perfect. The range is compressed. The reaction is fast. The move can fail quickly, so the long needs clean holding. If price reaches the entry and cannot build distance, do not force it. If price holds and moves away, the trade can work. If price returns into the midpoint, the long is gone. Now price reaches higher memory. It tests. It cannot keep clean freedom. The move starts to stall. Bodies become smaller. Pullbacks deepen. Reaction comes faster. Now the second trade appears. Additional short entry line. April 27th U.S. session lower boundary. Stop loss line. April 27th U.S. session midpoint. Take profit line. May 21st U.S. session upper boundary. Risk-reward ratio. 2.52. This short is stronger. Why? Because price already used the larger range. It tested the upper side. It failed to build distance. Then it returns toward April 27th U.S. memory. If price loses April 27th U.S. lower boundary and cannot reclaim it, the upper push is no longer in control. The same wider box now works in reverse. The long tried to move from May 21st U.S. upper boundary toward April 27th U.S. lower boundary. Then the short appears when April 27th U.S. lower boundary fails. Same memory. Opposite decision. Better ratio. The stop sits at April 27th U.S. session midpoint. If price recovers to that midpoint, the short has lost the lower pressure. Sellers no longer control the April 27th U.S. lower side. So the midpoint becomes the stop. Not because it feels close, because the structure changes there. The target sits at May 21st U.S. session upper boundary. That is where the range began. If the lower side fails, price can return across the hidden working box. This is why the short has better structure. It uses the same boundaries, but the risk-reward is stronger. Now the trader decision becomes clear. The first long is possible, but it needs clean holding. The second short has better reward, but it still needs failed reclaim. You do not trade both blindly. You wait for behavior. Price reaches. It reacts. It holds or fails. Only then does the trade begin. Now stop style matters. An aggressive trader may tighten the stop. The stop distance becomes smaller. Position size can become larger. Sometimes the tight stop is never touched. The trade pays faster. But there is a cost. A tight stop can be touched by normal reaction. The idea can remain correct. The position can still be gone. That is the pain. You are right, but you cannot collect. A conservative trader does the opposite. The stop is not too tight. The position size becomes smaller. The trade survives more noise. The chance of losing the position before the target decreases. But a wider stop must still pay. If the reward cannot cover the risk, the answer can become no trade. That is the real choice. Tighter stop, bigger size, lower survival, wider stop, smaller size, higher survival, no trade. Clean account. You choose based on structure, not emotion. Now trailing. If price earns additional distance, the target can move. But the trail should not move on every small candle. A useful trailing interval needs space. At least about 0.5 risk-reward unit is a practical minimum. Less than that often becomes noise. If you trail too early, you suffocate the trade. If you trail too late, you give back too much. When the target moves, the stop must move too. A target that moves without a stop is only hope, but the stop cannot become too tight. If normal reaction touches it, the trail damages the trade. If the stop stays too far away, the trail protects nothing. So the stop follows structure, not fear, not greed. Partial profit can help. If price reaches the first target and reactions start to speed up, protect more first. A conservative trader can take 60% first and leave 40% for continuation. If price holds the target and keeps distance, an aggressive trader can leave more open. An aggressive trader can take 40% first and leave 60% for continuation. If there are two trailing stages, the same logic continues. A conservative trader can take 50% first, then 30%, then 20%. A balanced trader can take 25% first, then 50%, then 25%. An aggressive trader can take 20% first, then 30%, then 50%. But percentages do not create edge. They only manage a trade that already has structure. May 22nd Asia gives the lesson clearly. The basis box is too compressed. The visible box is not enough. Price trades between older memory. May 21st, U.S. upper boundary. April 27th, U.S. lower boundary. The long can form first, but the short becomes cleaner when the lower side fails. Risk-reward changes the decision. The better trade is not always the first trade. The better trade is the one that survives the line. Price opens near old memory. Then the final session breaks lower. The session forms near the upper side. May 22nd U.S. session forms near May 21st U.S. session upper boundary. It overlaps there. It begins inside important memory. That matters. When a U.S. session forms near a prior U.S. upper boundary, price has to prove whether that old line can still hold. If it holds, the move can rotate. If it fails, the downside can open fast. May 22nd U.S. session first moves inside its own basis box. It does not break cleanly at first. It rotates. It waits. Then selling appears. Price drops. It breaks below May 21st U.S. session lower boundary. That is the first warning. The old session structure no longer holds. Price leaves the range. It does not just dip. It pushes down with force. Then price continues lower. It tests April 21st U.S. session lower boundary. That level matters. It is older memory. It is not random downside. It is where the drop can complete the next return. Now the short setup appears. Short entry line. May 22nd U.S. session lower boundary. Stop loss line. May 19th U.S. session lower boundary. Take profit line. May 21st U.S. session upper boundary. Trailing target. April 21st U.S. session midpoint. Risk-reward ratio 2.37. The entry sits at May 22nd U.S. session lower boundary. Why there? Because the U.S. basis box gives the active session line. If price breaks below the lower boundary and cannot reclaim it, the session has accepted lower movement. That is the short trigger. Not the first red candle. Not panic. The failed recovery below May 22nd U.S. lower boundary is the trade. Price breaks. It reacts. It cannot reclaim cleanly. Then the short has structure. The stop sits at May 19th U.S. session lower boundary. That stop is tied to older memory. If price recovers back there and starts holding, the short has lost the breakdown pressure. The downside move has returned too far. The short no longer has clean control, so the stop belongs there. A stop should not only protect money, it must identify where the idea fails. If price reaches that stop, the breakdown is no longer clean. You leave. No hope. No argument. No weekend holding because you want more. The first target sits at May 21st U.S. session upper boundary. That target completes the return through the prior memory structure. The trailing target sits at April 21st U.S. session midpoint. That is where the larger downside return can extend if selling keeps control. Risk-reward ratio, 2.37. That is attractive, but the timing matters. This is the last session of the week. Safe trading and a comfortable weekend. Do not always allow new entries here. A trade can be valid. The risk-reward can look good. The move can even pay. But the trader must still respect the clock. Final sessions carry different pressure. There are fewer candles left. Management time is shorter. News risk can wait outside the close. Emotion becomes stronger. Traders want one more win. They want to end the week with profit. That desire can damage the account. So the conservative answer is clear. If you want safe trading and a quiet weekend, do not enter the final session. Especially here. The final session already adds risk. Then the chart adds another warning. A bearish candle breaks far outside the session basis box. That candle has a range, larger than the basis candle itself. That matters. When a bearish candle breaks the session box, with a larger range than the basis box, the move is powerful. But it can also become late. A trader who enters after the expansion may be chasing the distance. The short can still pay, but execution becomes less comfortable. The better entry is near the line, not after the move is already stretched. So the May 22nd U.S. short has two sides. The structure is valid. The timing is risky. The reward is attractive. The week is ending. That is the decision. Aggressive traders may take it, but they must accept the risk. They tighten execution. They manage fast. They do not hold blindly into the weekend. Conservative traders can skip, or they only manage an existing position. Opening fresh risk near the end is not the same as trailing a position that already paid. That distinction matters. A fresh short adds new risk. A trailing short manages earned profit. Those are different actions. If the position already has profit, the trader can decide whether to hold part of it. If the trader has no position, the bar for entry must be higher. Now look at the breakdown. Price breaks below May 21st U.S. session lower boundary. It keeps moving. It tests April 21st U.S. lower boundary. Distance opens. Reaction is delayed. The short pressure is real, but the trade still needs management. If price reaches the first target and starts to slow, protect more first. If price keeps distance and pullbacks stay shallow, the trailing target can stay active, but the stop must follow. A target that moves without a stop is only hope. If the stop is too tight, normal reaction removes the trade. If the stop is too loose, the trade gives back too much. A useful trailing interval should wait for about 0.5 risk-reward unit, or more. Less than that can be noise. The market must earn the trail. Now partial profit. A conservative trader can take 60% first and leave 40% for the trail. That protects profit early. An aggressive trader can take 40% first and leave 60% for continuation. That gives more weight to the downside extension. For two stages, A conservative trader can take 50% first, then 30%, then 20%. A balanced trader can take 25% first, then 50%, then 25%. An aggressive trader can take 20% first, then 30%, then 50%. But again, the percentages do not save bad timing. They only manage a position that already has a clean line. If the trade is late, reduce size. If the session is ending, reduce risk. If the candle already stretched too far, do not chase. Now connect May 22nd. The Asia session was too compressed. It traded like the wider memory between May 21st U.S. upper boundary and April 27th U.S. lower boundary. The long appeared first. The better short appeared after failure. Then the U.S. session formed near May 21st U.S. upper boundary. It broke lower. It left the box. It tested deeper memory. The short paid. But the final session demanded caution. Same day. Different decision. First, choose between weak, long, better short, and stop style. Then, choose between valid short and weekend risk. The market does not only ask where price can go. It asks whether the trade deserves entry. A good level can still be skipped. A good direction can still be late. A good ratio can still carry timing risk. That is why execution is not prediction. Price reaches. It reacts. It holds or fails. Then the trader asks one more question. Does the risk deserve the reward today? The 1-hour chart moves fast, but the larger chart holds the reason. The week now returns to higher memory. The daily, weekly, and monthly charts do not replace the 1-hour chart. They frame it. The 1-hour chart shows where the trade happens. The higher time frame chart shows where the trade becomes dangerous. That difference matters. A 1-hour long can be correct. But if the daily chart is pressing into resistance, the target can end faster. A 1-hour short can be correct. But if the weekly chart is near a major midpoint, the downside can slow. A 1-hour no trade can look boring. But if the monthly chart is testing a major boundary, waiting can protect the account. So now we step back. Not to predict, to locate. Where did the week move? Where did price fail to stay? Which larger boundary pulled the 1-hour sessions back? This is where the daily, weekly, and monthly charts matter. The daily chart shows the week returning inside May memory. The weekly chart shows price still trapped inside the larger February structure. The monthly chart shows May testing the lower boundary of the 2026 first monthly box. That is why the week did not move freely. The 1-hour chart kept giving trades, but each trade had to fight a larger wall. You saw longs work, then stall. You saw shorts work, then rotate. You saw valid entries become difficult. When time, space, and target disappeared. Now the larger charts connect those moments. The goal here is not to explain the past. The goal is to prepare the next week. If price opens near the same higher time frame cluster, you do not chase. If price reclaims the cluster and holds, longs can form. If price fails again and returns below session memory, shorts can form. If price keeps rotating between the same lines, the account waits. The higher time frame does not give an entry by itself. It gives the environment. The session gives the execution. So we keep the same rule. Location first. Reaction second. Entry third. Risk always decides. Price breaks higher. But the daily chart refuses freedom. The May 1st daily basis box forms inside the February 1st daily basis box. It compresses only slightly. It overlaps almost directly. That matters. May does not start far away from February memory. May starts inside it. The May 1st daily upper boundary almost matches the February 1st daily upper boundary. That same area sits near the weekly 0.5 area. It also sits near the 120 simple moving average. Three pressures gather there: daily memory, weekly midpoint, moving average location. Price can move through that area, but it must hold. If it cannot hold, the move returns fast. That is what the week shows. Price first moves up. It breaks above the February 1st daily basis box upper boundary. That looks strong. It looks like a daily breakout. But the breakout needs acceptance. Price must stay above the boundary. It must create distance. It must not return into the box. Then price tries to reach the December 1st daily basis box lower boundary. But it cannot even test it cleanly. It fails before the real test. That matters. When price cannot even reach the next higher memory, the breakout is already losing strength. The move is not free. Distance is short. Reaction comes faster. Pullbacks deepen. Then price returns to the May 1st daily upper boundary. It tests that area multiple times. It tries to settle above it. It cannot settle safely. That is the key daily failure. The upper boundary is not just a line. It is the place where May, February, weekly 0.5, and the 120 moving average come together. Price touches. It reacts. It cannot stay. Then the weekly 1-hour moves make more sense. On the 1-hour chart, some longs worked, but they had to be managed quickly. Targets could not be treated as unlimited. Breakouts needed proof. Trailing had to protect profit. Because the daily chart was not giving open space. It was giving resistance. After the repeated failure near the May upper boundary, price returns into the May 1st daily basis box. It continues inside that box. Then it tests the May 1st daily lower boundary. Now the pressure shifts. If the May daily lower boundary holds, the daily structure stays rotational. If it fails, price can move toward the February 1st daily basis box lower boundary. That is the next danger. The market is no longer above the box. It is back inside it. A trader must adjust. You do not trade the week as a clean, bullish breakout anymore. You trade it as a failed breakout returning into memory. That changes execution. A long near the upper boundary becomes late. A long near the lower boundary needs holding first. A short after failed upper acceptance becomes more reasonable. But even the short needs a line. Not emotion. Not panic. A daily candle below a boundary is not enough. Price must reach a boundary. It must fail to reclaim. Then distance must open. Now think about the 120 simple moving average. It sits near the same upper daily pressure. When price rises into the moving average area and cannot hold above it, the moving average becomes part of the trap. It does not create the trade by itself, but it confirms location pressure. The trade still comes from price behavior. Reach. Fail. Return. The daily chart gives the main lesson. The breakout above February daily memory did not receive clean acceptance. The attempt toward December daily memory failed early. The May upper boundary was tested several times. Price could not settle safely. Then price returned into the May box and moved toward the lower boundary. That is why the week felt heavy. The 1-hour chart kept giving motion, but the daily chart kept removing freedom. Next week, the daily plan is simple. If price reclaims the May and February 1st daily upper boundary area and holds above the 120 simple moving average, longs can form toward higher daily memory. But price must hold. It must build distance. It must not return quickly. If price fails below the May 1st daily lower boundary, short pressure can move toward the February 1st daily lower boundary. But again, the short must not be chased. Price must fail to reclaim the broken line. If price stays inside the May daily box, the market remains rotational. Then, 1-hour trades must stay shorter. Targets must be realistic. Stops must protect structure. Trailing must not assume trend. The daily chart does not say, buy or sell blindly. It says one thing clearly. This area is not free. May upper memory. February upper memory. Weekly 0.5. 120 simple moving average. They sit together. Price tried. Price failed. Price returned. So next week, the first job is not prediction. The first job is to see whether price can finally stay above that cluster, or whether it keeps rotating back inside the box. The weekly candle breaks lower, but the larger trap began earlier. The weekly chart still moves inside the structure we have tracked since February. This week, price breaks below the February 1st weekly basis box upper boundary. It also breaks below the May 1st weekly basis box lower boundary. That matters. The upper side failed. The May base failed. Now price starts looking toward the March and April 1st weekly basis box upper boundaries. That is the next lower memory. Not because the market must collapse, because price has returned into the stacked weekly range. On the weekly chart, price had moved between the first falling trend line and the second falling trend line from February. Then price broke upward from that area. That breakout looked important, but it did not produce clean freedom. After the upward break, price moved sideways again. It did not run. It did not hold clean expansion. It rotated. That is the problem. A breakout from a trendline area still needs acceptance. If price breaks out but cannot move away, the breakout becomes fragile. Now look at the weekly basis boxes. The March 1st weekly basis box forms inside the February 1st weekly basis box. The April 1st weekly basis box forms inside the March 1st weekly basis box. The May 1st weekly basis box forms near the upper boundary of the February 1st weekly basis box. Compression continues. From March forward, the weekly boxes keep compressing. The market keeps folding into itself. That creates pressure. But pressure does not choose direction until price leaves and holds. Last week, the key scenario was clear. February, March, and April weekly basis boxes formed under the December basis box. Price had to break above the December basis box lower boundary to gain real freedom. It could not. The 120 moving average was also above. That mattered. Price rose into the upper weekly area. It could not clear the December lower boundary. It could not overcome the 120 moving average. Then price rotated back down. That is what this week confirms. The weekly chart did not reject randomly. It failed its stacked overhead memory. December lower boundary. 120 moving average. February upper structure. May basis box. All of them created pressure. When price could not move through that area, the weekly candle returned. Now the 1-hour chart becomes easier to understand. Why did longs need quick management? Because the weekly chart was not free. Why did shorts work after failed recovery? Because the weekly chart was rotating down. from overhead memory. Why did targets need caution near 0.5? Because the weekly midpoint was still active. The weekly chart does not give the exact entry. The session does that. But the weekly chart tells us whether the entry is fighting a wall. This week, many longs were fighting a wall. Some still paid, but they needed fast protection. Some shorts looked better, but they still needed proof. That is the key. Weekly pressure supports short bias only after 1 hour structure fails. It does not justify blind selling. Now plan the next week. If price stays below the May 1st weekly basis box lower boundary, the market remains under pressure. The next weekly memory sits near the March and April 1st weekly basis box upper boundaries. That is where downside movement can slow. If price tests those lines and holds, reaction can come. If price breaks through them and cannot reclaim, lower rotation continues. If price reclaims the May 1st weekly lower boundary, and then the February 1st weekly upper boundary, the short pressure weakens. But reclaim alone is not enough. Price must stay. It must build distance. It must not return the next candle. The weekly 120 moving average still matters. If price rises back toward it and stalls again, the same trap can repeat. The weekly chart gives a strong warning. The market is still compressed. The structure is not clean trend. It is stacked rotation under a higher wall. That means 1 hour trades next week must remain conditional. Longs are possible, but only from real holding. Shorts are possible, but only after failed reclaim. No trade remains possible if price stays trapped between weekly memories. The trader must not force a weekly opinion onto a 1 hour entry. The weekly chart sets the environment. The 1 hour chart executes. The weekly chart now says, the upper breakout did not fully succeed. Price fell back below important weekly memory. The next fight is whether lower weekly memory holds or fails. That is where next week begins. May still fights the monthly boundary, but the monthly candle is not finished. The May monthly candle is testing the lower boundary of the 2026 first monthly basis box, near the 0.5 area. That matters. The monthly chart is slower, but it controls the larger field. A 1 hour trade can look strong. A daily breakout can look promising. A weekly push can look alive. But if the monthly candle is testing the lower boundary of a major box, price can hesitate. Price can return. Price can move fast in both directions. Now ask the main question. Why is the May monthly candle moving like this? Look back. April monthly candle formed between the 0.33 area and the 0.5 area. It did not reclaim the full upper structure. It stayed inside the lower half. April also confirmed the upper wick of March. March had reached higher. It left rejection above. April moved under that pressure. Then April overlapped the February monthly drop. That matters. February created a large downside body. April did not erase it. April moved inside it. So May starts with old pressure still active. The market has not escaped February damage. The market has not fully repaired March rejection. The market has not moved freely above April structure. That is why May now tests the 2026 first monthly basis box lower boundary. The 2026 first monthly basis box itself formed overlapping the lower boundary of the 2025 first monthly basis box. That connection matters. Old yearly memory sits there. Current yearly memory sits there. The 0.5 area sits there. Price is not fighting a small line. it is fighting a major stacked zone. When price reaches a monthly lower boundary from below, the market has to prove acceptance. If it can reclaim and hold, the monthly structure improves. If it cannot, the lower boundary remains resistance. That is the monthly pressure. This explains the daily and weekly behavior. On the daily chart, price tried to hold near the February and May upper daily boundary. It could not. On the weekly chart, price failed under December memory and the 120 moving average. On the monthly chart, price is still dealing with the 2026 first monthly lower boundary. The same message repeats. Price can rally, but it cannot stay free. That is why 1-hour trades must be managed. You cannot enter late and assume expansion. You cannot ignore targets. You cannot leave profit unprotected near stacked higher time frame memory. Now the next monthly plan. If May reclaims the 2026 first monthly basis box lower boundary and holds above it, the structure improves. Then daily and weekly longs can have more room, but it must hold. A wick above the boundary is not enough. A touch is not enough. A fast rally is not enough. Price must stay. If May fails to hold above the 2026 first monthly lower boundary, the market remains under the monthly box. Then lower rotation can return. The 0.33 area stays important. The February monthly damage stays active. The daily and weekly charts can keep producing shorter, sharper trades. Not free trend, rotation, compression, failed continuation. That is the larger environment. Now connect everything. The 1-hour chart showed the weekly pain. Trades worked only when the session gave clear entry, stop, and target. The daily chart showed why breakouts failed. The weekly chart showed why the upper push lost freedom. The monthly chart shows why the whole move still fights the 2026 lower boundary. So the next week does not start with a fixed long or short opinion. It starts with the monthly line. Can price reclaim the 2026 first monthly lower boundary? Can the weekly chart recover May and February memory? Can the daily chart hold above the May and February upper boundary area? Can the 1-hour chart build distance after the session line breaks? If yes, long trades can form. If not, short trades and no trade decisions stay important. That is the full frame. Monthly location, weekly pressure, daily confirmation, 1-hour execution. The trader does not guess. The trader waits for price to reach, then watches the reaction. Then trades only when the line holds or fails, with enough space, enough target, and enough time.